Many investors don't think twice about the fees that they pay to their financial advisors. Some people see it as a necessary part of investing. If you are like many of my clients, you're busy. You don't have the time or maybe even the desire to sit down and figure out the complexities of finance, tax, and investing. But when I sit down and show my clients what they are really paying in financial advisory fees, they are shocked. My name is Megan Robin, and I am a California tax attorney. Today, we are going to talk about assets under management, also known as AUM, pricing models that are used by many financial advisors. On the surface, the AUM model of pricing seems simple. The way it works is a financial advisor will charge a percentage fee based on the amount of assets that they manage for you. These advisors will tell you that this fee structure aligns their interest with yours because their fee grows when your portfolio grows. You're on the same team now, right? Wrong, and here is why. An advisor using this fee structure is not going to want to recommend any actions that will reduce the amount of money that they are managing for you, even if those actions are in your best interests. For example, it may be in your best interest to pay off debt or invest in real estate or give to charity. But all of these actions would reduce the size of your portfolio that they are managing. In other words, it would reduce the assets under management and along with it, the fee that they get. So they are not going to want to suggest any action that would cause you to remove your cash from their control. This is a massive conflict of interest in my opinion. I just had a client who had a large chunk of money in a pretty great high interest savings account. She was getting a great rate. She was saving this money for her teenage son's upcoming college expenses. Before she became a client of mine, a financial advisor who uses this AUM fee model convinced her to move her money out of her great savings account into a money market fund that he was managing that was getting a lower rate. If he had really, truly had her best interests in mind, he would have recommended that she either open a 529 plan for her son or just keep the money where it was. But he wanted to increase his assets under management and therefore increase his fee. Next, financial advisors that use this AUM fee model argue that it makes the process seamless because they deduct their fee directly from your portfolio. This is complete BS. This does not make it seamless. This makes it hidden and not transparent because you never send in a bill or a check. You never see the money quietly slipping away. Let me give you another example. Edward Jones, which is a pretty well-known company, uses the AUM model. I'm recording this video in April 2025. I just checked their website, and as of right now, their current AUM fee is 1.4%. This doesn't sound like very much. But if you have all of your assets under their management, so we're talking cash, savings, investments, retirement plans, the portfolio size can really add up. Let's say that you have $2 million managed by Edward Jones. Well, 1.4% of $2 million is $28,000. That means that you would pay $28,000 per year in AUM fees for as long as you use their advisory services. These fees can get totally out of control when portfolio sizes get especially large. Many financial advisors also have a whole host of other fees in addition to this AUM fee. So that is not all you're going to be paying if you hire a financial advisor who charges like this. I have another video that talks all about hidden fees in investment portfolios that you can listen to if you're interested in learning more about this topic. It is so ironic to me that one of the biggest roadblocks that many people have to hiring a tax attorney is that they worry that hiring a tax attorney will be too expensive. I can't speak for other tax attorneys, but my rates are downright modest compared to the massive amount of money that these financial advisors are raking in with these enormous hidden fees. The two areas where I see clients losing the most money are in unknowingly overpaying financial advisors and unknowingly overpaying in taxes. I am a big proponent of learning the basics and handling your own investments, but I understand that that is not right for everyone and not everyone feels comfortable doing this. So if you do want to use a financial advisor to help you with your investments, find a financial advisor that charges flat fees or an hourly rate, and be sure to read their contract to make sure that that is all they are charging. Once you find a financial advisor that charges fees you are comfortable with, you are still not out of the woods. You want to find an advisor that is an independent fiduciary. This means that they are legally obligated to act in your best interests. However, there's an issue that I want to flag here. The law allows a financial advisor to call themselves a fiduciary even if they work for a large financial institution, brokerage, or Wall Street firm. I find this deeply problematic, and we will talk about why in a minute. But first, you should be aware that true fiduciaries can be very hard to find. So if you are having a hard time finding one, it is not you. These people are unicorns. What you find most are what are called dual registered advisors. Dual registered advisors can act both as fiduciaries and as brokers, depending on the situation. This dual registration designation applies to the majority of financial advisors out there. According to a quick Google search, 80% of registered investment advisors fall into this category. In my opinion, if a registered investment advisor is associated with a broker or dealer, they have lost their independence. To explain why, I'm going to read a few sections from a real contract clause that I pulled directly from the financial advisory service contract of one of my clients. Quote, "Your financial advisor has an incentive to recommend you purchase investments that create the most compensation for the firm and for the financial advisor." End quote. Here's another one from a different contract that another client had with his financial advisor. Quote, "Your advisor can favor certain securities or insurance products over others based in part on the compensation he or she may receive for selling them." End quote. You don't need to be a lawyer to see how this is problematic. Your best interests go out the window in the interest of selling funds or insurance products. If your financial advisor can make money selling funds or insurance to you, it is my opinion that they are no longer a true fiduciary, even though they are legally allowed to use this title. I strongly encourage you to critically evaluate the contracts and fee structures applicable to any current or potential financial advisors that you decide to work with. Ultimately, transparency is key. By understanding how your advisor is compensated and being proactive about discussing your goals, you can ensure that your financial plan serves your best interests and not just your advisor's bottom line. If you get lucky and find a financial advisor who is a true fiduciary, there is one more issue you need to watch out for. Some financial advisors miss opportunities or give the wrong advice because they don't fully understand the tax implications of their advice. In my practice, I combine my expertise in tax law with financial strategy to create financial plans for my clients that are truly comprehensive. To learn more about financial and tax strategy, subscribe to my channel, and I'll see you next time.